The fading dream of home ownership. Higher mortgage hurdles beat up on working class. An uproar is brewing over Canadian real estate, fueled by a misguided attempt to protect willing homebuyers from themselves. They are locked out by mandated stress tests. The federal government has dreamed up a convoluted, disguised way to ration housing. Only certain people are allowed to participate in the market. This comes from a June 2021 Office of the Superintendent of Financial Institutions, OSFI, requirement for federally regulated lenders. Buyers have to meet a centrally imposed stress test that requires income sufficiency for a 5.25% interest rate, or at least 2% above the quoted retail rate, the higher of the two. For a home buyer to get a bank to lend him money at 3.5% interest, he must qualify for a hypothetical 5.5% loan. The federal regulator should ease stress test requirements, if not eliminate them altogether, before they cause further harm and curtail construction and economic activity. A May 2019 report, The False Binary, the government needs to reframe its discussions about the mortgage stress tests, revealed the painful impact, now worse with tighter requirements. Will Dunning, the chief economist at Mortgage Professionals Canada, estimated that 100,000 Canadians, particularly millennials, were unable to buy a house as mortgage rules tightened. Such a mandate seems wrong-headed, and it is. However, to be fair, the proponents sought to address what they perceived to be high default rates. The problem is that raising the threshold for approval overrules lender discretion while doing nothing to help those struggling with insufficient purchasing power and constrained housing supplies. It merely keeps struggling Canadians at arm's length from the market. A blunt instrument. Dunning argues the tests assume an unrealistic scenario and do not take into account the future incomes of borrowers, which in many cases have a bright outlook. He calculated that 18% of prospective buyers who could currently afford to have their own homes have failed the stress tests. Rather than scrap the requirement entirely, he recommends a lower benchmark of 0.75 percentage points above the actual rate. Real estate boards and the Canadian Home Builders Association have also requested urgent reforms. A downturn in the real estate sector, which made up over 13% of the Canadian economy in 2021 and provided more than 10% of GDP growth that year, is in effect everyone's downturn. Canadian authorities, however, are skeptical regarding the dampening impact of their regulations. While banks and other stakeholders lobby to reduce or withdraw stress tests, since lenders, not regulators, are best qualified to assess creditworthiness, the OSFI seeks to expand the policy. Even the International Monetary Fund shows naivete and claims a gradual slowdown in the housing market is good news, rubbing salt into the wound. A lack of affordability has been rising in housing since the turn of the century, notably in Toronto and Vancouver and their satellite cities. Of Canada's 46 largest urban centres, 25 were severely unaffordable in the 2022 Demographia International Housing Affordability Report, an increase from 18 in 2019. Median home values in those areas are more than 5 times median pre-tax household incomes. Quote, since 2004 to 2005, the median multiple has nearly doubled, leading not only to a housing crisis, but also a cost of living crisis, unquote. Relative to incomes, housing has become twice as expensive in less than 2 decades. While the litany of barriers to supply have remained unresolved, the queues have grown longer with people in need. In late 2019, prior to COVID-19's arrival, more than 250,000 Canadians were on waiting lists for public housing assistance. 2/3 had been waiting for at least 2 years to be served. Struggling to find a place to call home, Canadians have been easy prey for subsidies and condescending public housing. In 2017, the federal government introduced the grandiose National Housing Strategy, but it has little to show for the $13 billion spent of a planned $70 billion. Piecemeal initiatives now span federal, provincial, and municipal governments that make legislators and governments feel and look good. However, as established homeowners see their asset values grow, handouts and promises for non-owners constitute scraps for paupers that do nothing to address the root causes laid bare by COVID-19. 2 simple actions could meaningfully address the long-term supply problem. 1. Open up land blocked off by greenbelts and zoning. And 2, eliminate or hasten licensing and permits, delaying construction. These would swiftly meet the rising demand and negate the need for destructive rationing. On the demand side, there are no easy answers aside from tightening federal purse strings and limiting immigration. That means fiscal austerity, a less expansionary monetary policy, and law enforcement. The prescription is simple, but applying it would require political self-awareness and wherewithal. Doomed to fail measures. The 2022 federal budget allocated 18% of funds to housing, as though a lack of demand was the problem. First-time homebuyers now enjoy a tax exemption, but those who buy and sell their properties in less than 12 months are subject to full taxation on their profits as business income. Other convoluted measures are a prohibition on some foreign purchases and subsidies for so-called affordable housing projects. These federal interventions are another setback for property rights and the Canadian housing market, as they muddy price signals. Rather than reducing barriers to supply, the government is imposing differentiated treatment towards different demographics. Not that this will achieve anything useful. Further, jacking up the stress test is flagrantly regressive. There are compelling benefits to buying homes, but individuals without major assets and high incomes find themselves unable to participate. The benefits associated with real estate as an asset, inflated by federal policy, are now more segregated. In particular, the working class on fixed incomes find themselves ostracized. Regulators are far from dispassionate seekers of the common good. They grudgingly admit mistakes and only change policies under significant pressure. Left unchecked, stifled housing activity is fomenting the very economic hardship policymakers are supposedly resolving.